we're going through the targeted anti-avoidance rules. So the first one is the thin capitalization rule. And that is designed to disallow deductions for undercapitalized companies where the ratio of capital to debt is artificially inflated in order to create a deductible expense to extract income from a company before tax. Now, to put that into normal human language, it stops you capitalizing a company with, say, £1, one share for £1, and loading all the other capital into it by way of debt, so you can take out interest and eliminate all the profit and therefore the tax at corporate level. So let's say, for an example, we have in GIB no tax on interest for individuals. A way which would a thing which would trigger this rule would be to capitalize a company very low, take everything out of interest. The individual doesn't pay tax on interest. The company doesn't have any tax liability because it has a massive expense which entirely wipes out its profit. So that's a really obvious way of doing avoidance. So we have this thin capitalization rule. In order for the thin capitalization rule to be triggered, the capital to equity ratio of the company must be the loan to equity ratio must be greater than 5 to 1. So if you've got £2 in shares and you've got £11 in debt, then that triggers it. The borrower must be a company and the lender must not be a company. So this doesn't say, the rule does not say that the lender must be an individual. It says it must not be a company. So a trust, a foundation, an LP, an LLP, all those things would trigger this. And the loan must not be at arm's length in terms of both its rate or its terms. So the loan must not be, and when we refer to arm's length, we're talking about generally what the OECD transfer pricing rules would give you. So it must be a non-commercial loan. Its terms must be non-commercial. So let's say the loan is for 150 years. That's not commercial. Nobody's ever going to lend over 150 years. That's one of the terms that might be a non-arm's length, but also the rate can be non-arm's length. So you're not just looking for, does the rate equate to what the bank would give you? You need to look at the terms as well. So you need to consider the loan in its entirety, not just separate, just in terms of its rate. Transfer pricing always looks at both sides of that, though we seem to forget that it's more than just the rate. That was emphasised by a change in the 2017 OECD transfer pricing guidelines. And finally, the company must borrow. The company borrows from an arm's. So there is a second type of trigger, which is where the company borrows from an arm's length party. So let's say it borrows from a bank, and the loan is secured against the assets of another person, and the loan is not at arm's length, either rates or terms. So that would be unlikely to be a bank because you wouldn't get a non-arm's length rate from a bank. But this second trigger is where you have basically your connected party is giving security in order to help you get a loan. And the effect of that is all of the interest, not just the surplus, all of the interest is recharacterized as a dividend and is not deductible. So you need to, with this rule, you need to remember that it's not just the surplus that's being recharacterized, but the entirety of the interest, which would seem a little harsh, but that's the way it is. That's the way it's written. So that's the first rule. It's nice and simple. Thin capitalization rules occur all over the world. It's a standard piece of law. So then we have the transaction with connected persons rule, and this says where at this time put the whole operative bit of the section in, where a person carries on business with a connected person, and it appears to the commissioner that the course of business between those persons is so arranged that the business done by the person chargeable to taxation in pursuance of his connection with the other person produces to the person either no profits, less than the ordinary profits, losses, or increases the loss which may be expected to arise from that business, the person shall be assessable and chargeable to tax in respect to the profits which might be expected to arise from that business if it were transacted in accordance with the remainder of the schedule. So this is basic transfer pricing, this rule. First thing we need to realize is that the commissioner must suspect there is an arrangement. The commissioner must drive the use of this rule. It would be a reassessment. It would not. You're not obliged to show this on your tax return. So the commissioner must suspect it before the rule is engaged. And then secondly, there must be two connected parties, and connected parties are defined in terms of connectivity. It's in the anti-avoidance rules. And they must be doing business together, and that business must be what is called in transfer pricing jargon as a controlled transaction. That gives an outcome which reduces or eliminates profit or losses, or increases losses, which would be expected to arise if they'd followed the arm's length principle. And then we tax, then the commissioner has the power to tax in accordance with what would be expected. So the word expected isn't defined. We don't have any statutory guidance on that, but I would expect it to be the applied in accordance with the transfer pricing guidelines. The current one in 2017, you can get those online for free, though they are very complicated. And we would be looking, the commissioner's challenge, you would be looking to evidence that your pricing is correct in accordance with the transfer pricing guidelines. Those of you that are part of big firms, big international firms, will have TP departments in cellars somewhere in London, sort of those like massively brained people that live in the dark and blink into the sunlight because all they do is spend their life thinking about transfer pricing. So this is the first instance of the use of transfer pricing in our anti-avoidance regime. So now there is an exemption from the application of the connected persons rule, and that is the unilateral safe harbour rule, which at Rule 4.1, so Rule 4.1 is modified by the unilateral safe harbour, and in that case, an expense will be allowed or deemed to be arm's length, even if it isn't arm's length, as long as it is the least of, it'd be allowed to the amount of the least of the amount of the expense itself, 5% of the gross turnover of the person for the accounting period of assessment, and 75% of the pre-expense net profit of the person for the accounting period or year of assessment. So that's a simple equation. You plug your expense into that if you've got something that's not arm's length, and then you are allowed the lower of those. And I guess you would make it a line if you were going to, if it's a controlled transaction. But I want to strike a note of caution here. Unilateral safe harbours are not generally considered acceptable in international taxation anymore. So if you've got an international group and you are not transferring properly in order to rely on the unilateral safe harbour, then you may well run into difficulties in the other jurisdiction because, as an example, DAC 6 highlights the use of a unilateral safe harbour as a hallmark of aggressive avoidance, and if we were subject to DAC 6 in its entirety, this would be reportable wherever you did it in the world. But if the arrangement concerns Spain, then this will still be reportable under the rump DAC 6 that we have in GIB, which applies the whole of the provisions of DAC 6 to Spanish facing arrangements. So whilst, yes, it's there, you need to be cautious about it because in an international context, because it may well be disallowed under the rules in the other jurisdiction. So there are special rules that apply to interest, and the amount of any interest paid by a person to a connected party in any year, which exceeds the amount of interest which would have been paid to an arm's length party, shall be deemed to be a dividend paid by the person and received by the connected party at the time of payment, and shall not be deductible in ascertaining the profits or gains of that year. Now, this looks very like, does it not, the thin capitalization rule? But the thin capitalization rule is only applicable where the lender is not a company. But the transaction with connected persons treatment of interest is applicable to all persons, and it does a different thing. It resolves the problem differently. If you remember on the thin cap rules, the thin cap rules deem the entirety of the interest paid to be a dividend, whereas under the transactions with connected persons rules, it seems to be, from the language, that it is only the excess of the arm's length amount which is treated as a dividend. So that's an interesting difference. I don't know why there's a difference. I wasn't in the room when it was decided. It could be, because there could be many explanations. From they were drafted by different people and put together, or there is a, you know, they perceived in 2010 when it was drafted, or 2009 when it was drafted, that individuals would be more of a risk of this, and therefore the provision should be stronger, but we don't know. So the treatment of interest rules only apply to loans. They only apply to the excess of amount of the interest, and deems to be an excess of the dividend, denies a deduction, increasing taxability. And then obviously you need to consider taxability in the hands of the recipient, because it actually gives a slightly odd result, in that if you had a Gibraltar company that was doing this, charging interest at non-arm's length for whatever reason, I mean, there would never be an investigation because both sides would pay tax on it, but the GIB recipient would pay 12.5% on the interest, but it would be tax-free on the dividend. So it can give a slightly odd result with certain structures. I mean, I don't think that would ever help anybody with their structuring, but it just shows that maybe the anti-avoidance rules and the later introduction of the interest charge, they were done at different times, weren't they? I mean, that's all we're saying. So there are other issues in the transactions with connected persons charge, and obviously this is a whistle-stop tour of quite a complex issue, but there is a denial of deduction for interest on some secured loans, which mirrors the secured loans provisions in the thin cap, and there is a rule about aggregating employment splits between connected employers, where one employment contract is in Gibraltar and one employment contract is not in Gibraltar. That's sort of breaking them up in order to avoid tax in GIB on the non-Gibraltar employment contract. So where there are connected parties. So that's what the transaction with connected persons rule is. It's basically transfer pricing with some more specifically targeted rules for interest, secured loans and employment contracts. So you need to be aware of it. And you need to understand that 4.1 applies only when the commissioner drives it, and you need to consider the other pieces to see whether it is you that puts it on the tax return or whether it is the commissioner that needs to raise an assessment based on it. So there is an exemption regime in order to get an exemption from ThinCap, transactions not arm's length with connected parties, secured loan interest, and aggregated employment contracts. So this is an intention-based exemption. This is important because it protects the rights of a company to do things for commercial reasons, which may otherwise trigger the objective tests contained in the anti-avoidance rule. So if we just flip back up to, I think it's the ThinCap. What have I got? There is, sorry, it's the transaction with connected persons. There is no purpose test this in 4.1. So you're not looking for, do they intend to avoid? It's just, does it have the effect of reducing tax? But the intention test is brought back in the exemption, which is applicable if the purpose of you can show that the purpose of avoiding liability to taxation was not the purpose or one of the purposes. And that's slightly odd and novel drafting, because normally you would see the words the main purposes for which the loans or other arrangements or any of them were affected, that the loans or other arrangements were bona fide commercial transactions and were not designed for avoiding the liability of avoiding tax, that the quantum of the loan or other arrangement is reasonable and proportionate in relation to the business of the person who would otherwise be assessed disregarding the loan or arrangement. Now, I think that all those three tests are essentially three faces of the same thing. In order to get the exemption, you would need to show that I'm not doing this for tax avoidance purposes. It is really commercial, and there is no design element to it. I just think there's a lot of words there, and it could be done a lot quicker, a lot simpler. But essentially, if you can meet those three variations on the same test, you will have a defense from ThinCap, transactions not arm's length with connected parties, secured loan interest, and aggregated employment contracts, anti-avoidance, which is good to know, right? So remember, it's there if you ever come across these. So that's the three main targeted anti-avoidance rules that you would see if you're involved with corporates and the exemption. Now, we also have a thing called transfer of assets abroad, which, when you hear those words as a tax advisor in connection with the UK, are absolutely terrifying. It's one of the strongest tools that the UK has in its armory as a piece of anti-avoidance. Similarly, not similarly, but in contrast to that, I have never seen this used. Has anybody from GATA who's present ever seen this used? I think the silence tells us everything. Yeah, so it's highly unlikely you'll see it, but you need to understand it's there. So it's very similar in a sort of simplified form to the UK Section 86 and transfer of assets abroad regime. They're two different. Transfer of assets abroad applies to income tax, and Section 86 applies to Taxation of Capital Chargeable Gains Act. So this is obviously modelled on that regime. The transfer of assets abroad regime in GIB is divided into two pieces. The first piece is the transferor charge, which would be equivalent to the settlor charge in TCGA Section 86 in the UK. And this applies only to individuals. There must be a transfer affected by the taxpayer in question. It does not necessarily need to have been to somebody in Gibraltar or by someone in Gibraltar, but there needs to be a transfer. Sorry. So to give an example of this, I've got a client. The example is of the UK provision, but it's the same rule. I've got a client who was based here in Gibraltar. He lived here for 4 years, I think. When he was here, he set up a company for very good reason, and then he went back to the UK, and the UK transfer of assets abroad regime was triggered, even though he'd never transferred anything abroad. It's a misnomer, essentially. Yeah. So there needs to be a transfer. It needs to be affected by the taxpayer in question, either a transfer or associated operations. So the associated operations phrase is very powerful. Anything. So if I transfer money to you and then you transfer money to someone else, that's a transfer for the purposes of TOA. And your transfer would be an associated operation. So if there's a chain of transactions that lead to something happening that would be effective for this rule, if I'd done it directly, that will all be caught. You can't be clever and work your way around it. Now, the individual either has to have the power to enjoy income of that person, or does enjoy income of that person, or is entitled to receive a capital sum from that person. And then, if that is the case, they will be taxable on the income arising to the person as if it was their own. So I put money into a Cayman Islands trust. Imagine this. I put money into a Cayman Islands trust and I divert my employment income into it. And I never receive the employment income. And then I have the power to enjoy that income because I am a beneficiary of the trust. I will be taxed as if that money is my own, even though I haven't taken any yet. So my employment income will be diverted to Cayman. I don't take any money out of the trust. Tough. I'm taxable as if it's mine. It doesn't work to simply shove it into a BVI company and say that I'm a consultant because this would be, and then not take it out because this would be triggered. That's what the transfer of assets abroad regime is aimed at. There is a secondary charge, a beneficiaries charge, which again mirrors the English rules. And again, it applies only to individuals. There must be a transfer, same rules as the transferor charge, and it must be done by someone else. Then the individual in question either has the power to enjoy income of the person to whom it's transferred, or does enjoy that income, or is entitled to receive a capital sum. And then when they receive the funds from the overseas person, they are taxable on that income as if they had earned it themselves, but only when they receive it. Sorry, I'm glad I got to the mute button before I sneezed. So that's quite a powerful tool. But again, I've never seen it used, and I've never heard of it being used. But it is there, and it needs to be taken into account. So they're what we could call the homegrown TARs, transactions with connected persons, thin capitalization, the exemption, and the transfer of assets abroad regime. The transfer of assets abroad regime, by the way, is not subject to the exemption. Then we also have the EU anti-avoidance rules, which were mandated for us to implement under the ATAD, the Anti-Tax Avoidance Directive, before we left. And we did implement them in a bit of a flurry at the end of our moment of being in the EU. Now, this is just a summary. If you want to see more, if you want to understand the rules in more detail, I have done, some of you will remember, I did a set of bite-sized webinars during COVID. And if you want to look at those, I see that we've put on all 6 of them, but the first 4 are specifically about these rules. If you want a summary of what accrued and derived means, there's one there. And if you want a summary of the Gibraltar double taxation agreement with the UK, there's one there as well. So this is necessarily a summary, but you can get more details there. So interest limitation liability rule. This is actually quite a powerful tool. Again, this is a German rule that was extended across the EU, so we can blame them for it. And this is something which needs to be reflected in the tax return of the company in question. Right, so what it does is it denies deductibility of interest over a specified amount. So you cannot just have a load of bank debt, because this applies to all debt. ThinCap only applies to connected parties who are individuals or non-companies, whereas this applies to all debt. So the maximum amount of deductible expense which can be attributed to interest of any kind, whether it's bank debt, arm's length debt, commercial debt, shareholder debt, whatever, it's all included in the calculation, is 30% of the EBITDA of the company, or 3 million, whichever is greater. That comes as quite a shock when you first hear it, because the question is always, well, why does this include bank debt? It just does. You can't do anything about it. I noticed that the transcript just transcribed bank debt as Baghdad, which is nice. So 30% of EBITDA, or 3 million, whichever is the greater, that is all you're allowed. Everything else, you don't get a deduction. It's treated as profit. That's just the way it is. There are some exemptions. Some funds and other financial institutions are exempt. There are exemptions for certain kinds of property business, and there is what's called a long-term infrastructure exemption. I won't go into any more detail about that because it is quite complicated. That's the basic headline. The long-term public infrastructure exemption exempts the charge completely. The buildings exemption, you have to have more than you have to be renting buildings for less than 50 years, and you need to meet another set of criteria. It's very similar to a UK exemption, and you can find more in the bite-sized tax. So the second EU rule that we have is the exit tax, right? So this is applicable when there is a transfer of assets from head office to a permanent establishment outside Gibraltar, so as to put the asset beyond the scope of taxation in Gib. There is a transfer of assets from a permanent establishment in Gibraltar to a head office or another permanent establishment outside Gibraltar, so as to put the assets beyond the scope of taxation in Gibraltar. Transfer of tax residence of a company out of Gibraltar. Transfer of a business under a permanent establishment out of Gibraltar to another country, so as to put it beyond the scope of taxation. What this does not do is it does not tax when you sell an asset to somebody who's not in Gib, right? So you need to remember, because I get asked that question all the time. Is the exit tax payable? No, it's only when you're basically trying to shift an accrued capital gain, an unrealized capital gain, out of Gibraltar, so it's not, or out of the jurisdiction, so that it's not taxable. It would be make much more sense in a UK or a French scenario, where, let's say, you've got a UK company that's accrued a lot, so it has a massive unrealized capital gain on some IP or whatever, and then it moves its tax residence to Gibraltar, where there is no capital gains, and then it sells the IP. Boom, tax-free IP, tax-free capital gain. So what's the tax payable on? Well, it's payable on an amount equal to the difference between the market value of the transferred assets and their value for tax purposes. Value for tax purposes is kindly not defined in the legislation, that the Commissioner has indicated to me and others that the tax written down value is what he will look at. And if that's not available, then simply the book value. And that is only applicable under our exit tax where the assets would otherwise generate assessable income for the purposes of GIB law. So if you've got an asset in Albania that you're using and then you transfer it in such a way that would trigger 1, 2, 3, or 4, then that's not subject to the exit tax because it's not a Gibraltar tax question. Or if you've got assets in Albania that could not generate tax assessable income in Gibraltar, and you move your tax residence, then you would have zero tax exit tax liability. Payment can be deferred for up to 5 years in certain circumstances, and that's the SOP that means that it doesn't trigger the freedom of movement of capital rules inside the EU. So what is this? This is I mean it's a solution to a problem that doesn't exist in Gibraltar because we don't have capital gains tax. So it's a bit of a nonsense to have it in our law at all, really. But we do. So there you go. We have to deal with it. It is a form of capital gains tax for me, but it's as close to our territorial tax base as we can possibly get. How do you administer it? Well, there is no fixed method or return as yet, but I would suggest the Commissioner has said that he expects companies to enter into negotiations, or basically, frankly, just notify him as soon as they begin the process to redomicile or to move their residence or whatever. But I think in most circumstances, the kind of company that would be doing the things that trigger the exit tax will be outside the scope of the territorial base. But we still need to bear it in mind. And I think, I can't remember, I think he said that he doesn't want any nil returns. And I would be okay with that, not finding a nil return, because there is no administrative rule yet as to how we deal with this. So that's the exit tax. And then we have the controlled foreign company rule. Controlled foreign company rule is designed to stop you opening a subsidiary in a lower tax jurisdiction and dumping income into that, then taking a dividend and benefiting from our participation exemption in Schedule 1. So it applies to companies which are controlled foreign companies. So what is a controlled foreign company? A controlled foreign company is a company which is held directly or indirectly 50% as to voting rights by a Gibraltar ordinarily resident company. So remember, this is only applicable to companies, unlike, say, the Israeli CFC rule, which is applicable to individuals as well. A company held directly or indirectly as to 50% as to voting rights by a Gibraltar ordinarily resident company which has assessable income. That's an interesting two-tiered test to meet that, or its associated enterprises. So it must have assessable income to trigger the CFC rules. Gibraltar doesn't care if your company is not a Gibraltar taxpayer. And by that, I mean a company which actually has income which may give rise to tax or is certainly assessable. The second limb is a company held directly or indirectly 50% as to capital by a Gibraltar ordinarily resident company with assessable income or associated enterprises. And the third is a company of which a Gibraltar ordinarily resident company is entitled to receive 50% of the profits. And I think, if I am correct, that third limb is not phrased in terms of assessable income. No, that's wrong. The tax, yeah, okay, so that's wrong. That's framed in terms of assessable income as well. Sorry about that. So that's because the word taxpayer is defined as an ordinarily resident company with assessable income. So all of these rules are only applicable if you have assessable income. That's the EU section. So that's 1, 2, and 3, and the actual tax paid is lower than the difference between the tax that would have been charged under the Act and the actual tax that is paid. So does that mean, the accountants will tell me, does that mean that essentially the tax rate in the subsidiary jurisdiction has to be half of the Gibraltar tax rate? So again, it's really a solution to a problem that we're unlikely to encounter in circumstances of a trade. Our territorial base makes this pretty redundant, because if let's say you establish a BVI company and that BVI company has Gibraltar source trade income, it's a Gibraltar taxpayer anyway. You're not taking it out of the scope of Gib tax just because you place it inside a company which is non-resident. However, you might trigger that in the situation of a GIBCO which has, a non-GIBCO which has interest, royalties, non-trade income from movable property, those 2013 provisions that are tucked away in Class 1A, Class 3, I can't remember which the last one is, of Schedule 1, Table C. So it could be relevant, but it is unlikely to be something that we see. And I believe that it is for the taxpayer to declare this on their return, because this is not triggered by the commissioner believing something or the commissioner's state of mind in any way. So now here's a barrel of laughs. Hybrid mismatches. This is very complicated, and every time I read it, I think this is entirely Byzantine. Again, I think this is a position which should be included in the tax comp rather than wait for the commissioner to find you. I think this is driven by the taxpayer. So let's try and sum up easily what hybrid mismatch rules are designed to eliminate. And they are designed to eliminate a position where a group can exploit differences in characterizations of entities or structures in different jurisdictions. So the classic one is, or was, I don't think it works anymore, but there was a point when the UK used to view a Delaware LLC as a taxpayer in its own right. And the Americans viewed it as transparent, like a partnership. So you could do things working in that mismatch between the way the authorities treated Delaware LLCs, or all LLCs. So that's what this is trying to stop. And the outputs of those arrangements are that you either get a double deduction, that is, you can claim the same expense twice. You get a deduction without inclusion, that is, you can pay money from one entity to another entity. The first entity gets a deduction and the second entity does not need to include it in a tax return. And the rule is only triggered when those outcomes arise as a result of the legal characterization of either the entities involved or the instruments that are involved. What is not being stopped is where a deduction is granted to a payer and that money is paid to a recipient in a jurisdiction which has no corporate tax, which it ends up not paying corporate tax, that is not a hybrid mismatch. What that is probably reportable under DAC 6, but it's not a hybrid mismatch. It has to be something to do with the entity or the legal characterization of the instrument for the hybrid mismatches rules to be implemented. So we have 7 cases which trigger the hybrid mismatch rules. The first is that a payment is made under a financial instrument that gives a deduction without inclusion. So that means that the payer claims a deduction, so he treats it like interest. And then because there's a participation exemption or a parent subsidiary directive exemption in the recipient country, that that entity treats it as if it's received capital, and therefore it's exempt. The Luxembourg structures that were called PECs and CPECs used to do this a lot. The instrument was capital when you wanted it to be and interest when you wanted it to be. The second case is a payment to a hybrid entity which gives rise to a deduction and non-inclusion as a result of the way the recipient jurisdiction allocates the taxability of that payment, i.e. is the recipient see-through in the home jurisdiction but treated as opaque or a taxpayer in its own right by the paying jurisdiction. So it would just flow through to the recipients, to the partners. Let's say it's a partnership. Let's say jurisdiction A treats this kind of partnership as an entity, but the home jurisdiction of the entity treats it as a partnership. It would just flow through to the individuals above, and they may or may not pay tax on it, but there will be no tax paid in the recipient jurisdiction. A payment to a permanent establishment that gives rise to a deduction, non-inclusion, as a result of different rules in the permanent establishment headquarters jurisdictions allocation between the home jurisdiction and the PE jurisdiction. So this, why does this arise? This arises because a permanent establishment is not a separate entity, but some countries treat it as if it is, and the home jurisdiction may not treat it as if it is. So you could get a deduction in the let's say the permanent establishment buys something from headquarters. The permanent establishment would get a deduction. Headquarters would not include it because it's not a transfer from a different entity. But because the permanent establishment is treated by the host jurisdiction as if it is a separate entity, then you would get a deduction, but it would not be included in the HQ. Number 4, I told you it was complicated. Number 4, a payment gives rise to a deduction non-inclusion because of a disregarded PE. A similar outcome, playing in the difference of treatment between permanent establishments. A payment, number 5, a payment gives rise to a deduction non-inclusion because a payment is disregarded under laws of the payee, that's the recipient jurisdiction. Number 6, a deemed payment between head office and a PE or 2 PEs gives rise to a deduction non-inclusion. And number 7, any circumstances in which you can have a double deduction. Okay, so that's a struggle. But what is the way these are resolved? So there are 2 methods. The first rule is the denial of a deduction. And the second is that the deduction in relevant cases is not, if the deduction is not denied in the paying jurisdiction, then it is included as income in the recipient jurisdiction. So an income inclusion rule. So you've got a denial of deduction rule and an income inclusion rule. The first position should always be the denial of deduction. And you should include this on your tax returns, in your tax comp. So that's really quite complex. If you think you've got a hybrid mismatch, you should be taking advice because it is very complicated. There are many highly qualified tax advisors in Gibraltar that you can take advice from. Some of them are here, some of them are not, but look out for a CTA or an audit. They will be able to help you with it, as many accountants could as well. And some lawyers, right? So that's the targeted anti-abuse rules. or anti-avoidance rules. You'll be able to see they are specifically targeted at certain behaviours. But what happens if you come up with a fantastic new wheeze that there isn't a targeted anti-avoidance rule for? Well, we have a backstop catch-all rule called the General Anti-Abuse Rule, GAR, or General Anti-Avoidance Rule. I think that it's probably an anti-avoidance rule, actually, rather than an anti-abuse rule. But let's call it the GAR. So the GAR states at section 40 brackets 1 of the Income Tax Act 2010, where the Commissioner believes that a person who is or would otherwise be chargeable to taxation in accordance with this Act has entered into an arrangement which eliminates, reduces, or would eliminate or reduce the amount of taxation payable, and that arrangement is artificial, fictitious, or has elements which are artificial or fictitious, he may disregard the arrangement or those parts of it which eliminate or reduce the taxation payable and assess the person on the amount of the taxation due in the absence of the arrangement of those parts of the arrangement which the Commissioner disregards. That's the text. What does it mean? So let's break it down. The first element is that the Commissioner must believe that there is an arrangement. So this is driven by the Commissioner. This is a matter of investigation, assessment. It is not necessary to include it in the tax comp, though obviously you shouldn't be carrying out highly aggressive avoidance anyway, but that's not the place for it to be declared. There's a disclosure regime further on. The arrangement must be entered into by someone who is or would otherwise be liable to pay tax. It's not relevant to anything which is not entered into by a GIB taxpayer or somebody who without the arrangement would be a GIB taxpayer. The arrangement he believes exists must reduce or eliminate the tax payable, and he has to believe that the arrangement is artificial or fictitious or has elements of artificiality or fictitiousness. You need to understand that this does not use the language the or one of the main purposes. It is not about the purpose. It is that it is artificial or it is fictitious. Now we can argue antics for a long time around whether that actually means that it needs to have a design, but no, he's not going to say what were you imagining this did when you did it. He's just going to see, is it artificial? Well, the question that everybody always asks is, well, what's an arrangement? What is in scope and what is not in scope? This is very wide. It is not defined, but I would advise strongly against the idea that you can define arrangement and then you can be half an inch on one side of that definition and avoid the applicability. It should be given its normal meaning. And I do not think that we should advise and hide behind, sorry, I'm going to sneeze again. No, I'm not. We should not hide behind the words, it's a grey area. It's not a grey area. Yeah, it's not a grey area. An arrangement is very wide. If you do anything which has an element of deliberate planning, and these words are from Farnborough Airport case, anything which has an element of deliberate planning or coordination to bring about a particular state of affairs, that is an arrangement. There does not need to be an agreement. There does not need to be a contract. There does not need to be any of those things that gives an arrangement solidity for an arrangement for this test for an arrangement to be met. So a verbal conversation, we're going to do X, you're going to do Y. Yeah, that's sufficient. So the status of the transfer pricing guidelines. So we should read the GAR in such a way as it is consistent with the rules applicable under Article 9 of the OECD Model Treaty. This is in section 40 brackets 2, I think. And we should read the GAR in such a way as is consistent with the transfer pricing guidelines in force at the time the Act came into force. Now, the Act came into force in 2010, which means that we should be looking at the 1997 guidelines. The Minister hasn't made any regulations or rules to change that. But practically, the Commissioner uses the transfer pricing guidelines in force at any given time, which means that we are looking at the 2017 rules. Transfer pricing is very complicated. We don't have time to go into it here. If any of you listen to my podcast, there is a basic introduction to transfer pricing tucked away, and I can't remember which episode, but you can find something. You can find more guidance there. It's important to know that this does not mean the fact that the sections refer to the transfer pricing guidelines does not mean that this is only the GAR is only relevant when transfer pricing is in play. It is applicable to any arrangement. It is not only relevant when there's TP. It's very, very wide. It's a very strong power. The main thing that I think we need to understand when if it's applied is I read it as saying that the Commissioner has the power to disregard. In fact, it says disregard the arrangement. So all he can do is remove it. I don't think he has the power to impose the correct position. I think he just has the power to say, I'm going to disregard the existence of, say, that interest-free loan. I don't think he has the power to impose an interest rate on an interest-free loan. All he can do is say the loan will act as if the loan didn't exist. But it's never been litigated, and we don't know where that would land if it did get litigated. So that's the backstop rule. That's the general anti-avoidance rule. How do they gather information? You know, we live in a world where we have lots of information regimes, but does Gibraltar have one? So how does the tax office get the information to tell them that things are happening? And we do have a disclosure of notifiable arrangements regime in section 41 of ITA 2010. It is like a more simple version of the DOTAS regime.
Yes, sir.
So it's in section 41 of ITA 2010 that tells us what a notifiable arrangement is. And a notifiable arrangement means any arrangement which falls within any description prescribed by the Minister by regulations. And guess what? There are no regulations. Or which enables or might be expected to enable any person to obtain an advantage in relation to any tax under this Act that is so prescribed in relation to arrangements of that description, or are such that the main benefit or one of the main benefits that might be expected to arise from the arrangement is the obtaining of that advantage. So it either does or it can be expected to give an advantage. Now, it's interesting that 2 and 3 contains a main benefit test, but 2 does not. So if you actually have obtained an advantage, then it's always in scope. But if you only expect to obtain an advantage, it has to be one of the main benefits. Again, that's inconsistent drafting. I don't understand why that's different. It just is. And in this section, notifiable proposal means a proposal for arrangements which have entered into would be notifiable arrangements. So there is a method to report before the arrangement is carried out. So who needs to report? Basically, it's anybody who enters into the design or implementation or advises or recommends or assists implementation, accessing, the arrangement. So it's either advising somebody to do it, implementing it, designing it. All those things bring you into scope. And in relation to notifiable arrangements, by virtue of 1BB, a promoter in relation to a notifiable proposal is implemented, which is implemented by those arrangements, or if in the course of a relevant business he is to any extent responsible for the design, the organisation, management, arrangement, tendering of advice on, or marketing. That's important, marketing. So if you're any of those people, and it's very wide, if you're any of those people, then you have 30 days between making the proposal to implement or becoming aware of the arrangement to report. Now, lawyers are protected by legal professional privilege, but the people who are not protected by legal professional privilege, unfortunately, are accountants, chartered tax advisors, if they're being chartered tax advisors and not lawyers, if they're not dual like I am, fiduciaries, trust and company service providers, all of those things. You would need to report. And that you have 30 days to do that. And if you don't report, it is an offence. So in conclusion, because I know you're all desperate to get away because it's very dry, anti-avoidance rules for most people. In conclusion, it's a 3-tier system. There are certain specific behaviours that have neutralisation rules, some of which are the responsibility of the taxpayer to include in their tax comp, some of which are the responsibility of the commissioner to raise an assessment in connection with. They deal with specific behaviours. The GAR is designed to catch everything else that has an effect. It's effectively the future proofing of the Income Tax Act. And then if you do things which gain a tax advantage or can be expected to gain a tax advantage, then you are obliged to report that if you are one of the relevant people. And if you don't, there's a fine. So it's specific behaviours, backstop rule, information gathering. That's how the anti-avoidance regime is designed, and that's how it's implemented. Are there any questions? Is anybody still awake? Okay. I don't think anybody's raised their hand. Oh, there's a blob in the chat. Yes, the question is always, will I be sharing the slides? Yes, I will be sharing the slides. And even though I didn't manage to start the recording at the right time, if I can get it off my computer, I will stick it on the GATA YouTube channel. So just some information. We have another workshop's a grand word for a webinar, isn't it? We'll have another webinar on the 13th of February 2024. Yes, it's that close. 2024 is around the corner. That will be given by John Azzopardi, who's a director at RSM and a CTA. He will be discussing the UK-Spanish Treaty. If you have any questions, please don't hesitate about today's talk or about GATA in general. Please reach out to me. You'll find my email address there, or you can contact us at gata.events&marketing@gmail.com. So thank you very much for coming. Please be aware of the anti-avoidance. We don't have an entirely free regime. You can just do whatever you want. These rules are important, and they are part of what keeps us off those blacklists and grey lists. So please be aware of them. Thank you very much for coming. And
Thank you,
hope to see
Graham.
you soon.
Thank you very much,
Thanks.
Graham.
Thank you.
Thank you very much.
Thanks, Graham.
Thank you.
Bye-bye.
Bye.
Bye.